Welcome to This Explainer. Okay, buying a home in Pennsylvania is incredibly exciting, right? But let me tell you, there is a massive financial danger in jumping into this market totally blind. Today, we're going to break down the true costs of PA homeownership and exactly why you need to protect your wallet by running the numbers before you ever make an offer. So, you've thought about buying a place in PA? It's arguably the biggest financial decision you're ever going to make. Yet, it's wild how many eager buyers just jump straight into the deep end. You know how it goes. They start touring open houses, totally falling in love with those wraparound porches and beautifully finished basements, but they completely ignore their actual, realistic monthly costs. And honestly, that is exactly how a dream home turns into a heavy financial burden. You've fallen up with the layout, but you get absolutely crushed by the mortgage. I love this point from our source material. Financial peace of mind begins with a clear understanding of your monthly commitments before you commit to a mortgage. It really hits the nail on the head. Calculating your costs early on, way before you sign your life away on a 30-year contract, is literally the only way to ensure your new home doesn't become a nightmare. You absolutely must know the numbers before you hold the keys. Because let's be real, just hoping for the best, that is definitely not a sound financial strategy. All right, let's get into the first part, the PA Mortgage Calculator Explained, demystifying your financial future. Look, your monthly payment isn't just one giant lump sum. It's actually broken down into 4 core components. In the real estate world, we call this PITI: principal, interest, taxes, and insurance. A solid Pennsylvania-specific mortgage calculator takes all 4 of these vital elements and bundles them together to reveal your true monthly obligation. That way, you aren't caught off guard by any hidden fees creeping up on you. Let's start with the principal. This is essentially the foundation of your debt. It's just the sticker price of the home minus whatever cash you bring to the table up front. It's pretty simple math, really. Putting more money down directly shrinks this base, which dramatically lowers your monthly payments right out of the gate. Knowing this number ahead of time dictates exactly how much house you can actually afford to even look at. And then there's amortization. Sounds a bit intimidating, right? But it's really just the secret life cycle of your loan. A calculator maps this out beautifully for you, showing how your early payments are going to mostly go toward interest before eventually shifting to pay down the principal later on. Calculating this ahead of time lets you track exactly how your equity, your true ownership of the property, will grow month by month. It basically gives you the long-term view before you make a short-term mistake. Moving right along to the next part, why you must calculate first, the ultimate financial armor. So why the big push to calculate this stuff before you act? Well, trying to do mortgage math by hand is incredibly difficult, and frankly, it's almost always wrong. There are just way too many variables at play. A digital calculator, on the other hand, gives you instant clarity. You can quickly adjust things like your down payment or the loan term, testing your budget in real time without all the sweat and anxiety of doing complex algebra sitting at a lender's desk. Just think about the interest rate for a second. It's super volatile, and right now, it's hovering around 6.59%. A PA-specific calculator lets you plug in exact up-to-the-minute rates for places like Pittsburgh or Philadelphia. And listen, even a tiny 0.5% shift in this number will drastically alter your monthly budget and add tens of thousands of dollars to your long-term costs. If you aren't calculating this before you go shopping, you are flying completely blind. Okay, let's jump into the next section, avoiding costly home buying mistakes, dodging regional traps. Here's where it gets really specific to Pennsylvania. You need a local tool, not just some generic national one, because property taxes vary wildly across the state. Take Allegheny County, for example. It sits at 1.61%, but just a couple of hours away in Bedford County, it's only 0.81%. 2 identically priced homes can have vastly different monthly costs, and a local calculator is literally the only way to catch these crucial regional swings before they completely wreck your monthly budget. But hey, even the absolute best tool in the world is useless if you feed it bad data, right? If you plug in outdated rates, ignore those changing county taxes, or completely forget to add private mortgage insurance when you're putting down less than 20%, well, your estimated monthly costs are going to be a total illusion. You're just setting yourself up for a nasty surprise at the closing table when you realize your payment is hundreds of dollars higher than you guessed. This quote from the source material is a great reminder. The goal of financial planning is not just to predict the future, but to prepare for the variables that might change your path. Preparation really is everything. Using local tools, whether it's a calculator set for Erie, Scranton, or Allentown, helps you prepare for the specific variables that are unique to your area. It's not about just throwing darts and guessing a number. It's about avoiding a massive financial shock. Predictability is for sure your best friend in real estate. And that brings us to our final section, your winning home buying strategy, using estimates to conquer the market. So, how do we actually execute this? It's just 5 simple steps in a local online tool. You enter the price, your down payment, the rate, and the term. Boom. You instantly get a rock solid estimate. This lets you confidently compare entirely different financial scenarios right from your couch, long before you ever set foot in a single open house. You get to walk into the housing market armed with hard data. Once you've got those estimates in hand, you can start getting strategic. You can test out different mortgage types. Compare the rock-solid stability of a fixed-rate mortgage against the initially lower, but definitely riskier, adjustable rate. Or if you're a first-time buyer, you can see exactly how an FHA loan impacts your out-of-pocket costs. Knowing all your options ahead of time really puts the power right back in your hands. Running the numbers also perfectly highlights the massive trade-offs between different loan terms. You can instantly see the difference. Sure, a 15-year loan is going to demand a higher monthly payment, but it will save you an absolute fortune in interest over the long haul. On the flip side, a 30-year term stretches everything out, giving your day-to-day budget a lot more breathing room. Testing these scenarios first makes sure you pick a term that actually matches your lifestyle. And all of this prep work feeds directly into the golden rule of real estate, the 28-36 budgeting strategy. You basically take this rule and apply it directly to your calculator estimates, making sure your total housing costs stay strictly under 28% of your gross income and your overall debt stays under 36%. Setting this firm boundary is what guarantees your new Pennsylvania home remains a place of comfort, not a source of overwhelming stress. Oh, and remember, once you have these estimates squared away, take them to a licensed local lender to really finalize your master plan. So let's wrap this up. The absolute most crucial takeaway from this explainer today is this. Before you take that massive leap into the Pennsylvania real estate market, run the numbers first. Seriously, use a local calculator, arm yourself with absolute financial clarity, account for those local taxes, and take total control of your journey. So the only question left is, are you going to calculate your future, or are you just going to let the market decide your budget? Thanks for hanging out with us for this explainer.